What do you make of this volatility in the market?
I think, as the world settles to a lower growth and, a lot of uncertainty that's around, I think is getting factored in. We're all reacting to, developments both globally and locally in terms of, the policy actions. So I think we will have to live with this volatility over the next few months till we get a fair bit of certainty on how the COVID, will play out and how the reopening of the economies will settle down. While most of the economies are coming back in terms of opening up the shutdowns, there are concerns about a second wave and also about how we can medically progress on containing COVID. So these are still, uncertainties that we are all grappling with. So to the extent markets will be traders' delight to say so. We don't expect a directional move significantly in the near term, but of course, these corrections, whenever they happen, provide good opportunities to add on for investors. The long term definitely, as usual, looks good, but the near term would be definitely uncertain and a lot more volatile at this point in time.
We had almost everybody from India Inc. yesterday on the channel, which is from ITC to Siemens, from TVS to Sense, which we even got from CII. And KK, this is what they told this is what this indicated to us, that in the short term there is a lot of uncertainty. In the medium term, growth will remain low. Long term, we don't know because the shape of the economy is changing. So what gives you the confidence that right now every decline is a buying opportunity?
Yeah. So if you look at the recovery as we build in, I think the first 6 months of this fiscal year is a challenge, but we are quite hopeful that globally and locally the world will start to live with COVID, even if there isn't a vaccine or a clear drug found. We would need to move on in terms of opening up the economy, building in a bit of isolation for the infected people, but at the same time, one would find it extremely difficult economically and politically to keep the industries locked down. That is what we have seen globally and also in India. So we believe that I think we need to come to terms with COVID, and that is what the governments are doing. In the meantime, I think the policy action from the central banks and wherever possible from the governments will help put in more liquidity and money in the hands of consumers at large, so that there isn't too much of bankruptcy, etc., that gets played out. So as long as we believe that the next 2 to 3 months we take care of the balance sheets, which are a little soft and prone to defaults, I think we would come back, because I think this is basically a lot to do with the supply side. There isn't industries which are working at this point in time. There are definitely people who have ability to consume, in spite of the fact that there are some job losses and job cuts. It is not that the whole of India or whole of global has lost its paycheck, right? So it is basically a little bit of cut here and there and a deferment, which the government is also trying to address through various means. Also, I think the basic consumption, that is the bedrock of the economy, is broadly intact. As you get the industries opening up and the logistics into the system well geared up, as the products are available in the market and the distribution to the consumer is in place, we would have consumption recovering in the next 3 months. So we are not unduly worried about the demand side. Of course, there will be some slackness that we are all building in terms of economic forecast, but I think it's more a supply side issue and not a demand side issue at this point in time.
Okay. Sure. KK, how do you see the dynamics playing out when it comes to the financials? They continue to, of course, be a large chunk of most portfolios. There is both a high risk element there as well as, of course, an expectation that that's what's going to revive the economy or lead from the front. Do you see a complete, somewhat of a consolidation, certain pockets perhaps that will emerge stronger than others? How do you see this playing out? Because we have seen quite a bit of pressure even on the financials in the last few weeks.
Yeah, the financials have been the best performing sector over the last many years, and particularly the retail-oriented banks, etc. We see that the current situation definitely has put put the onus on the stress that could build up potentially because of the moratoriums and the lockdowns. So we believe that the financials, as a sector, would underperform in most rallies in the near term. We think that the markets, the investors will readjust to a lower exposure to financials, particularly the lending institutions, which are having a weak liability profile. Typically these are the low quality NBFCs, etc., which do not have a liability franchise. So these wholesale funded institutions will find it extremely difficult to remain very relevant, and when their asset side also is kind of stressed at this point in time, they are the ones who would be the companies to avoid or sectors to avoid. So we believe that the financials exposure in the medium term would gravitate to the well-run large private banks and few quality non-banking financial companies, and more move towards the wealth and the insurance-oriented place. So that's the change within the financial composition of an investor that we see, and overall we see the financials as an exposure probably coming down for investors at large, particularly the institutions. We think there are other sectors, which have been out of flavor for a long while, which are coming back, given that the prospects of those companies and the sector are improving, particularly on the pharma side, etc., with the improvement of the US generics markets, etc. So there is a clear shift in terms of leadership away from financials as we see it over the medium term.
Within, just to sort of probe that a little further, within the larger private names, as you mentioned, even there, do you see some kind of upsets? Do you see just a couple of leaders emerge? Because all this while we've had perhaps the handful that continue to be the market favorites. Do you see a change even there?
I think clearly the larger and well-run banks are getting stronger. They are the ones with liquidity, and they are the ones with good liability franchise. So I think we don't see major disruption on the top tier banks in general. I think it is more the mid-tier and the smaller companies that we are probably worried about in terms of their growth trajectories, given the current stress that is impending, and also the capital position of these companies.
Right. KK, would you say IT in that sense is also resilient to what's going on in the world? Because in the recovery, IT also will be fastest to bounce back. That's pretty much what we've heard in terms of a commentary from most IT majors as well. TCS said that there's going to be a recovery by year end, and IT Tech as well seem to be indicating just that, saying that a single-digit decline in June quarter before recovery coming in the September quarter. We've just heard from from HCL Technologies as well, which delivered its numbers. And largely, one has to say, I mean, I know the earnings are for the quarter gone by, wherein COVID only hit in the latter part of the quarter, but largely resilient in terms of the earnings as well, IT so far at least.
The IT space is definitely going through its own challenges in terms of the framework of work at office or work from home, etc. And on the demand side, we believe and understand from a lot of consultants and from companies that there is a sharp decline in terms of intent to start new projects, to scale up existing projects, and also talk about new initiatives. So to the extent, I think the growth is going to be muted, but we need to look at this small negative growth vis-a-vis the kind of hit that other sectors are taking at this point in time. So relatively speaking, I think IT is a area where balance sheets are very good. Demand conditions aren't, dropping off the cliff at this point in time from a one-year perspective, and there is a lot of cost savings the companies are able to wriggle out. So I think incrementally, I think there is a very good chance that more money flows into software companies at this point in time, pretty much across the large and the mid-cap sectors there. Given that there are a lot of initiatives and niche areas that smaller mid-caps are working on, including digital and cloud, etc., a lot of them have very good competitive advantages to build into the current weakness in the market.
Also wanted to, discuss the paint segment with you. While the economy has been in a slowdown for the past 2 quarters now, one saw that paint companies were fairly resilient to the slowdown up until, of course, COVID hit. We were chatting with the Asian Paints management just yesterday, them indicating that they're now diversifying completely into hand sanitizers as a segment. But, having said that, it could be debated whether lower input costs are any solace for paint makers in a lost summer. Do you really think that paints could again be that one segment which will be able to revive? Or do you think because of the COVID-led slowdown, this sector is also likely to be impacted and hit as hard as any other?
I think definitely, the paint demand is going to be pretty much negative through the first 6 months of this year. People are going to be quite wary about getting people into the homes, and it's just kind of a discretionary spend item. So we believe that discretionary spend could suffer more in the first half of the year, with a recovery into the second half, basically. So on the paint side, even the monsoons in the next 3 months are going to be painful from a demand perspective. So we are not so much positive on paints at this point in time. Valuations are expensive. Any input benefits would be passed on to customers so that they can derive some amount of demand, basically. So I think we would be not so much interested in paints at this point in time. I think the way we look at it broadly is that there is a global cyclical recovery that one could build into the portfolio with a little bit of a lag from a domestic recovery. So I think portfolios probably need to be a little bit more balanced at this point in time, with adequate exposures to also global cyclicals. And one should probably, as a fund manager, try to be closer to benchmarks at this point in time. Given that there is a bit of uncertainty that's in the air at this point.
KK, how much, to what extent do you feel we're still very closely linked to what happens around the globe? We've got a lot of uncertainty still brewing. All eyes on really how soon perhaps a vaccine or a medical cure can be discovered. We've got the trade wars perhaps looming large once again, once people have a moment to sort of look outside of, dealing with the current COVID crisis. Does that also spell out, further uncertainty apart from what we're tracking domestically?
I think, globally, the central banks have been faster to act, and also in terms of size of the initiatives on monetary policies. So they're kind of helped backstop the crisis. Also, the governments are, been batting on the front foot, and particularly on the US. So I think they have been really helping a lot of corporates and the population at large. So I think the risks, I think, are much lower at this point in time, the way we see it. Also, given the current situation, and in terms of how China sentiment is playing out, I think there is a big geopolitical axis which is shifting in the favor of India. So I think whatever is happening on the global trade front, etc., definitely I think has a good positive implications towards Indian companies and India. We see a lot of investments in the medium term that will come towards the Indian shores. I think so. I think the strength of the rupee also, in a relative sense, indicates the kind of the positive outlook in terms of FDI flows into the country. You have also seen recent deals with large corporates that's been done at a stiff valuation. So I think the crises or not, I think there are a lot of MNCs who want to be in India and who now find a lot more reason to be shifting focus away from China into India. So I think we are in for good times from that perspective, and we should build on that shift in terms of how the global investors look at India from a longer term perspective. I think that's a very big positive for us.
Again, of course, KK, you're talking long term, and I appreciate that. But do you see how much conviction do you have in this? Because the government is, of course, trying to do whatever it can to make sure it continues to attract further investments into India, whether it be manufacturing or otherwise, but large-scale investments in order for long-term growth. But in the immediate future, or even let's say for the next year, given the concerns around coronavirus and, of course, doing anything outside of one's borders, and B, until it really becomes clear to what extent the government can ease things for foreign businesses, do you really see the possibility of further inflow?
I think the recent investments that's happened, from Facebook, etc., do give you a sense that in spite of COVID, in spite of all the fears, there is definitely big MNCs looking at the Indian opportunity. We also believe that there are also equally big deals that are happening on the telecom side and also on the retail side. In addition to the other investments that are happening in the specialty chemical side, including the automobile sector. So I think, we should definitely believe in the Indian, the demographics, the kind of market that we offer to people. I think near term, there could be some data, but that's also something that's factored into the markets in terms of pricing, etc. 7,500 was a panic bottom. Probably we may even, test that, in the near term as results come and guidances come. But I think, every correction provides a good entry point, for investors, basically. So while we can always think about, short-term volatility and avoid, but I think we don't have as much of a good asset class in the long term, to beat inflation. And we also seen that debt markets are equally risky. So it is definitely, not just the equities which are volatile, but, even debt is quite volatile from an asset class perspective. So I think that's from a equity perspective. And from a ease of doing business in India, I think, MNCs are used to working in different sorts of countries. And I think even back home, it is not that everywhere, policies and regulations are very, very favorable to industries. There are always some hitches here and there. And countries like us, which are developing, do have to, have some regulation to protect ourselves and the local industries, etc. So it's got to be a bit of a slow opening up of regulations And to the extent, I think the MNCs do understand, and that's how joint ventures and partnerships are very important to build and thrive in India rather than just to go it alone. So I think it's a well-established model for many companies to partner with strong Indian companies and build on the markets here.
All right, thank you for joining us this morning, KK. And clearly, deals like the Facebook and Reliance Jio deal perhaps